September is historically a weak month for the stock market, but the flash September 20th sell-off wasn't a product of a general investor fear. It was a China sell-off, as concerns about a looming financial crisis in China sent panic waves across the investing community and triggered a massive sell-off in Chinese stocks in particular. I am not late on the Evergrande situation. I just wanted to digest the technicals of Chinese stocks and give it some time for them to sell off. And guess what? I didn't rush into the Evergrande situation like other YouTubers to get my views. Instead, I care about the results of my subscribers more than my views, so I purposely waited a week for the Chinese stocks to keep falling, and now I'm going to inform you of the opportunity in the market. I'm going to mention a lot of new stocks, so make sure you stick around. I'm sure by now you know one of China's leading property developers, China Evergrande Group, is on the verge of defaulting on debt worth $300 billion. It is pretty much reminiscent of the Lehman Brothers financial crisis of 2008, and investors fear Evergrande's potential collapse could have a domino effect and slow down China's growth. Yes, the risks are real, the news is big, and everyone took action early by buying too soon. For a long-term investor, a market sell-off is the perfect opportunity to buy Chinese stocks, especially if you believe China's economy will expand in the years to come. I've been an investor since I was 19 years old. I've been around the block. After getting my finance degree and studying the market for 5 years in college, I can tell you that I see a lot of opportunity here for the long-term investor, not necessarily for the short-term investor, because there might be a little bit more downside, but I've taken my time to come out with my thoughts because I believe that the market would pull these stocks lower, and that is exactly what happened. So now that I'm happy with the valuation of some of these Chinese companies, I want to reveal the best investments that you can make for huge, fast profits. The first stock I have is Alibaba, ticker symbol BABA. Earlier this month, Alibaba looked as though it had bottomed. Speculators bet on Baba stock bottoming at $160 per share by bidding the stock up close to $180 in its 50-day simple moving average. For the past few months, as news of China's regulatory agencies cracked down on the world's second largest economy, technology companies, took place, it was clear that there was some big companies that the government won't hurt all too badly, since the entire nation relies so heavily on the morale of these successful stories. Although we have seen Alibaba fall to under $150 per share, I don't see this as time to panic. Instead, this is where I think the bleeding is going to start to wane, and we still see people making great returns by buying a growth stock for value prices. As Alibaba is set to grow their net income by 40% over the next 3 years and hold such a large cash and investment position that they can gain interest income off of at a 10-fold rate, by the way, than they pay in interest expenses, it's very clear that the company is healthy and has more than enough to survive and thrive during these temporary hurdles. I mean, the stock is like Amazon of China. I have zero fear that they are going to encounter any balance sheet issues or financial problems. I believe the stock is undervalued by up to 50%. Year to date, it is down over 36%. We might not touch the $270 peak anytime soon, but I believe we can see the stock go up to $200 per share soon once the news and media stops pushing the fear of Evergrande, or once the Evergrande situation just settles down. The next stock I have is JD, Chinese e-commerce company headquartered in Beijing, China. E-commerce giant JD.com provides a platform for third-party sellers to sell merchandise rather than selling goods themselves. I like what they're doing a lot in logistics. I think that they're building out a lot of the competitive advantages that we've seen with Amazon as far as logistics goes. They started off doing first party, they're adding more marketplace sales, and this company overall is underappreciated because its bigger brother Alibaba gets all of the attention. Year to date, the stock is only down 14%. It has not been beaten down as much. JD.com is uniquely positioned to grow along with China's economy. In terms of having a strong basket of Chinese stocks, this is a stock that has shown resilience during this more turbulent time. And again, even if we don't touch the $106 peak, I still think the stock has 20% upside to $90 per share. The next stock I have, and you already know Uncle Henry is a longtime bull on this one, is NIO. Electric vehicles or EV makers appear to be the natural champion for China, and NIO is a likely standout among those companies. Thanks to its charismatic entrepreneur, CEO, and lineup of luxury EVs, the company has long been referred to as the Tesla of China. That's the reputation I look for beyond anything else. I really don't care how rich you are or how great you are. Nobody likes a person that isn't humble. I look at personality first in all relationships in my life and in business. Same goes with companies. I don't care if you come up to me with an investment opportunity in a get-rich-quick course. If I know the product or service isn't doing good by the customer, I want nothing to do with it. Reputation is everything. It's the most valuable asset. NIO has tremendous support by the government, government, and I really like the reputation. NIO also has a CEO that's similar to Elon Musk in that he is innovative and focused on quality. Quality over quantity. I can't say that enough. Again, this applies to all walks of life. After reputation, I look at cash. I'm a businessman with a finance degree. I want to see the money, and I know that's what you guys care about as well. NIO delivered 21,896 vehicles in the second quarter, more than double the total from Q2 2020. Although the chip shortage impacting all automakers threatens to slow near-term expansion, NIO's agreement with its manufacturing partner gives it the capacity to eventually produce up to 240,000 units annually. NIO is not profitable yet, and trading at 12 times sales is not inexpensive, but the company has $7 billion in cash on its balance sheet to ride out whatever happens on the horizon, and it continues its expansion in China and as well the international markets, starting with Norway this fall. And the company has established itself as more of a lifestyle brand than a car maker, offering NIO clubhouses where customers can drop in, hang out, and the company is selling a line of branded accessories, clothing, and food products. This is no mistake. This is a smart business move by management. NIO looks like the right company at the right time as China works through its growing pains. There is no way I plan to sell NIO anytime soon, and I'll be holding this stock for the long term. The fourth stock I have is Yum China. Yum China is a restaurant chain that operates more than 11,000 locations in China. It's a spin-off of the US restaurant group Yum Brands Inc., and it has the licenses for those brands in China. Yum China's most important brands are KFC and Pizza Hut, and it runs Taco Bell in China, in addition to locally grown brands such as Little Sheep and East Downing. Yum China is an ideal holding in an uncertain period such as this one. The company has more than 400,000 employees, giving it a very strong reason for the government to permit it to operate normally. As it turns out, restaurants aren't really much of a politically sensitive area. In addition, since Yum remains in the picture, it helps provide more transparency for foreign investors. Yum China is selling for less than 30 times forward earnings, and analysts expect the business to grow both the top and bottom lines at a double-digit rate in coming years. Year to date, the stock is up over 18%, which is proof of investors' positivity. The market cap is only $37 billion. I see the stock rising another 30% from these levels. Fifth stock I have is DiDi. DiDi Global has aimed to become the Uber Technologies of China. Offering ride-sharing services, DiDi seemed like a surefire win. The company had topped foreign competition to capture a huge chunk of the market, and it was set to make a lot of money in the coming years. DiDi launched its IPO at $14 in July. Within weeks, however, the stock did not perform well. China's government announced that DiDi's application had to be removed from the app stores due to privacy violations. Additionally, Chinese government officials stationed themselves in DiDi's corporate offices to oversee the company. Investors still haven't given up. The stock has dropped from $14 to below $8. The market cap is still double of Lyft, but less than half of Uber. That's why I'm covering this stock fifth on the list. It does have a bit more risk, and I want you guys to be smart with the way you invest your money. If you want to see my live trades, my option signals, have access to me, 2 different coaches, a licensed CPA, you can book a free call by submitting an application in the first link below for my private option Discord. Thank you so much for watching, and I'll see you guys in the next one. No one ever sees me, I'm losing